It is important to keep in mind during a time like this, recession, inflation, fear, unemployment, worries about unemployment going up, all of these things being in mind, there's probably never been a time in the last 10 years more important for you to get clear about your investment philosophy.
In uncertain economic times like a recession, it's important to be mindful of how you invest your money. In this regard, Patrick Bet-David, a serial entrepreneur and financial educator, says the 10 rules for investing during a recession have proven to be a game changer for every investor. These rules can help you weather the storm and come out ahead. In this video, I'll reveal these 10 rules that will enable you to make the most of the recession period as an investor. Stay tuned till the end, as you wouldn't want to miss out on anything. Let's get started. Number 1, invest in people.
Number 1 P is people. So why people? Why not a stock? Why not a mutual fund? I love seeing a track record of a person that's continuously building a strong reputation, that's getting results, that has a new idea, and I'll say, you know what?
According to Patrick, people are the most important investment you can make during a recession. He believes that while stock markets and mutual funds may be in flux, the track record of a person with a strong reputation for getting results is an invaluable asset. This is largely because people will always support the idea or notion of such individuals. Take Elon Musk, for example. From his PayPal venture to Tesla to SpaceX to Boring Company to his recent flip-flopping on the Twitter acquisition, he remains a popular and influential figure in the business world. People follow him not because of his projects, but his successful track record and ability to get things done. Similarly, many other entrepreneurs and business leaders have built strong reputations for delivering results, and they're worthy of investment, even in tough economic times. Even recent research by the World Bank supports the point that investing in people is the smartest thing to do economically. In this research, most wealth in high-income countries comprises human capital, a smaller percentage of wealth in middle-income countries, and an even smaller percentage in low-income countries. For example, looking at the chart on the screen, you will see that the top quartile, which is made up of the top 25% of countries that have improved human capital, had a vastly greater level of overall wealth than the bottom 25%, which have invested the least. You can see the difference is enormous. Number 2, consider perpetual investment.
Number 2P is perpetual. And what do I mean by perpetual? Anything that I know I have to buy every month, every week, every day, services, products that are perpetual, I will make the investment into that because it's part of our life, and you can't just buy it one time and that's it.
The second rule is to consider perpetual investment. Perpetuity investments refer to investments that have no maturity date, meaning they last indefinitely. This characteristic favors these investments for investors seeking assets that offer reliable and steady cash flow without a predetermined end date. There are various forms of perpetuity investments, including perpetual bonds, perpetual preferred stocks, and real estate investments. Each of these investment options possesses distinct characteristics that appeal to investors. Also, investing in perpetual products and services can be a savvy strategy during a recession. These are goods and services that remain in demand regardless of economic conditions. Examples include essential utilities, healthcare, basic consumer goods, and certain technology services. These sectors exhibit stable or even increasing demand during recessions, making them attractive investment opportunities. By investing in these sectors, investors can potentially mitigate the impact of economic downturns and benefit from consistent returns over time. This type of investment option is predictable. This predictability can be especially beneficial for retirees or those looking to supplement their income with passive investments. Perpetuity investments can also provide peace of mind, knowing that the income stream will continue regardless of external factors. In addition to offering stability, perpetuity investments can also protect against inflation. Many of these investments are designed to increase payments over time to keep pace with inflation. This feature can help ensure that the purchasing power of the income stream remains stable, even as the cost of goods and services rises. So, for investors concerned about the impact of inflation on their investments, perpetuity investments can be a valuable tool for protecting their purchasing power. For example, Social Security benefits in the United States are a form of perpetual investment, adjusted annually to account for changes in inflation. In addition to their predictability and inflation protection, they can provide diversification benefits to an investor's portfolio. Investing in various assets with a predictable and stable income stream can reduce their overall portfolio risk and increase their resilience to market volatility. For instance, a portfolio that includes real estate and preferred stock can provide diversification benefits and reduce the risk of loss due to a downturn in one asset class. Number 3, invest in highly sought-after items.
The next P is phenomenon. And what do I mean by phenomenon? Phenomenon is something that comes out of nowhere. Let's just say hypothetically, and by the way, this is a very small percentage of when I invest. It's not a big, it's a smaller one because the risk is always going to be higher. This could be collectible cards. This could be art. For some, it could be NFTs or crypto.
According to Patrick, the third rule is to invest in highly sought-after items or collectibles with the potential for a high return on investment. These types of investments can be extremely risky, but they also have the potential for a massive payoff. NFTs, or non-fungible tokens, have upended the traditional idea of what constitutes a rare asset. They've created a new way of collecting and investing in digital artwork, trading cards, and other rare collectibles. Unlike physical assets, NFTs have the added benefit of being easier and cheaper to maintain, and their digital nature makes them more secure against theft or damage. One of the advantages of investing in NFTs is the ease with which they can be bought and sold. NFTs are built on blockchain technology, allowing for secure and transparent transactions without needing a third party. Without a centralized authority, NFTs can be traded globally, across borders and time zones. Another is that while these assets are highly volatile, a single sale of one can create the pathway to being a millionaire. In recent years, the value of NFTs has skyrocketed, with some pieces selling for millions of dollars. For example, the chart on the screen shows that the market cap of NFTs has risen to $432 million, with most high-profile NFTs sold for nearly $70 million. The profit potential grows as more people become interested in NFTs and digital assets. Crypto is also a similar case. Crypto has the potential for high profitability, especially during economic uncertainty. But at the same time, it comes with significant volatility and uncertainty. To prevent being affected by the volatility of these investments, Patrick advised against putting a large percentage of your portfolio into them. Rather, you can invest a small percentage of your investments in high-risk, high-reward opportunities. It can be worthwhile. The key is to carefully consider the risks and rewards before making decisions. Number 4, look for companies that address tangible problems.
Fourth P is problems. And what do I mean by problems? I like when I sit down with somebody, they come and they say, hey, here's a problem, here's how we're solving it.
The fourth rule to consider when investing during a recession is companies that are problem-solving in nature. In other words, a business or product that addresses a real, tangible need or solves a problem. This could be anything from a service that delivers food to your door to a company that offers eco-friendly alternatives to single-use plastic. Whatever the problem is, the company should be able to clearly and convincingly explain how their product or service is the solution. If they can do that, it's more likely that the company will be successful in the long run, even during a recession. These companies can be found in healthcare, utilities, and groceries. For instance, the healthcare industry had one of the lowest percentage increases in unemployment during the Great Recession, making it one of the most recession-resistant job sectors. Utilities fall into this category because they are about as steady as possible. Regardless of the economy, we typically don't change how much we use electricity, water, or other utilities. During a recession, people frequently forego eating out and ordering takeout, which causes grocery sales to soar even higher. Number 5, choose an investment that protects against future risk.
Hear me out before you go to number 6. I've been in the insurance space for 21 years, right? My whole business is preventative. What's preventative? you know eventually we're all gonna die. We all get taxed, we all gonna die, it's gonna happen no matter what. So insurance was preventative.
The fifth rule is investing in something that protects against future risks or losses. A common example of this is insurance, which can help protect against financial loss in an unexpected event, such as death or illness. Insurance policies, such as disability insurance or unemployment insurance, can provide a safety net by replacing lost income during a recession. Property and casualty insurance can protect assets such as homes, cars, and businesses from damage or loss during economic downturns, helping individuals and businesses avoid significant financial setbacks. Health insurance can mitigate the financial impact of medical emergencies or illnesses, which may become more common during economic hardship. In addition to insurance, other investments that may be considered preventative include commodities like gold, which can help to hedge against inflation. Historically, gold has been considered a haven investment during times of economic uncertainty and high inflation. Its value tends to rise as the purchasing power of fiat currencies declines. Investors often view gold as a reliable store of value and a hedge against inflation, which can lead to increased demand and higher prices during periods of economic instability. One example of this was in the 1970s, when the US dollar experienced rapid inflation, leading to a surge in gold prices. Also, gold can provide an important level of diversification to your portfolio, as gold prices have historically negatively correlated with other asset classes. Finally, another reason why some investors choose to invest in gold is for the potential financial gains that can be realized over the long term. Number 6, invest in patents.
But a patent creator, inventor with a great supporting cast, I will consider investing into those as well.
The sixth potential investment opportunity is in patents. Patents can be valuable, providing the holder exclusive rights to an invention for a set period. But not just any. According to Patrick, a great patent alone is not enough to guarantee success. Having the right team to execute the patent's potential can be a key factor. Patents can generate steady revenue streams through licensing agreements or royalties, providing a stable source of income even when other revenue streams are affected by economic fluctuations. Also, it can be leveraged as a strategic asset, especially in industries with high levels of innovation. They can attract potential investors or partners seeking to capitalize on unique technologies, fostering growth opportunities even in downturns. Investing in patents also diversifies a portfolio, reducing overall risk exposure. While traditional investments like stocks or real estate may fluctuate during recessions, the value of patents tends to be more resilient, providing a buffer against economic volatility. Patents typically have a long lifespan, offering protection up to 20 years from the filing date. This long-term perspective aligns well with investment strategies focused on sustained growth and resilience against economic downturns. Number 7, choose a great product.
7P, product. Here's what I mean by product. So the other day, I'm talking to a friend and he says, hey, Patrick, let me share with you this product. What's the product? This product allows you to produce any video content you're creating. They practice and get your voice down and they're able to translate what you're saying in 24 different languages. I said,
Moving on to the 7th rule, which is choosing a great product to invest in. A great product is essential for any successful investment, and this is something you look for when evaluating potential opportunities. A great product is unique and innovative and addresses a real need in the market. It's not enough for a product to just be good. It needs to be something that has the potential to disrupt the status quo and make a real impact. But it's not just about the product itself. It's also about the team behind it. The company must have a strong vision and a good supporting cast of skilled employees and leaders. These kinds of companies are large-cap companies. These established, well-capitalized companies with strong balance sheets and diversified revenue streams tend to fare better during recessions than smaller, riskier ones. Number 8, look for a predictable investment.
8P is predictable. Here's what I mean by predictable. Anything I can invest in, this is not a high rate of return. This is not something that's going to be astronomical. This is not something where you're going to go brag to your friends about, did you see this stock I bought or this? No.
The eighth rule given by Patrick is to look for an investment that is predictable, meaning that the investment has a stable, predictable return. A predictable investment is not necessarily exciting or high risk. Still, it is a reliable option with a history of delivering consistent results. This could include ETFs, mutual funds, or other low-risk options that don't offer the potential for high returns but don't carry the same level of risk. Mutual funds can be a good option during a recession, as they often have built-in diversification that spreads risk across various investments. This can help to cushion the impact of a market downturn. However, the fees can be expensive for certain actively managed funds. On the other hand, exchange-traded funds offer a few key advantages. They typically have lower fees than mutual funds because they are passively managed. This means that ETFs are designed to track the performance of a specific index like the S&P 500 rather than being actively managed by a portfolio manager. In addition, value stock ETFs can be particularly attractive during a volatile or down market because they invest in companies that produce essential goods and services, which tend to hold up better during economic downturns. Predictable investments are an important part of any well-diversified portfolio. They can help to offset the risks of other, more volatile investments. They may not get the headlines, but they are a key part of a balanced investment strategy. Number 9. Invest in property with a huge marketable rate.
Everything when it comes down to property, there's got to be a strategy behind it. If you're just winging it, whether it's land, commercial, residential, rental, it doesn't matter.
The ninth rule is to look out for the marketability of the property you're investing in. Property in this regard is real estate. Real estate investment is an option to consider when the market is down. Real estate can attract investors because buying property at lower prices is possible when the economy is slow. You may also get a much better mortgage rate during a recession when rates are likely much lower than otherwise. You can lock in an attractive mortgage payment for potentially decades, so even if rates rise later, you still have that below-market mortgage rate. Many investors did this in the last few years, scoring a 30-year mortgage below 3%. As inflation rises now and in future years, they're paying back the mortgage with cheaper dollars, making real estate an attractive inflation hedge. So, if the economy recovers and property values rise, you could profit significantly from your investment. Additionally, real estate has historically appreciated over time, so even if the economy doesn't recover immediately, you may still see a return on your investment in the long term. Investing in rental properties is also a good way to diversify income streams, which can be especially important during a recession when job stability weakens. However, when it comes to property, it's important to have a strategic approach to investing to maximize your chances of success. Property can be a valuable asset, but many factors must be considered when making an investment decision. For example, properties in high-demand locations or with unique features may be more likely to appreciate value over time. On the other hand, properties that are more generic or in less desirable locations may be less likely to increase in value. Number 10. Invest in priceless moments.
10th P, last but not least, is investing in priceless moments, memories that will last a lifetime.
The 10th rule is to invest in priceless moments, which refer to experiences or memories that can't be quantified in monetary terms. For example, spending time with loved ones, traveling to new places, or creating meaningful traditions can all be priceless investments. While these experiences may not have a clear monetary return, they can impact your life and create memories you will cherish forever. So while it's important to consider traditional investments like stocks and real estate, it's also worth investing in the things that matter most to you and your family. After all, some things are truly priceless. That's a wrap on the rules for investing during a recession by Patrick Bet-David. These rules can help you navigate the challenges of a recession and make sound investment decisions that will benefit you in the long run. Which of these rules will you implement in your financial lifestyle? Let me know in the comments section. If you found this video insightful, don't forget to like and subscribe for more financial tips. See you in the next one.